Well, welcome everybody to another edition of Ask an Accountant. And this is one of the editions of this event that we're actually having a guest speaker. Mazen Asbahi is one of my favorite attorneys because we spend a lot of time in the healthcare space. And Mazen is a very accomplished, experienced attorney dealing with physicians, physician groups, and other healthcare types of businesses. And he's been part of large groups, small groups, buy-ins, sells, and he's going to talk to you today about transitioning a practice and maybe bring us more aware of some of the things that we might not think about. Mazen, take it over.
Thanks, Judy, and thanks, Lauren, Bill, and the whole team, Janine at ANA. Appreciate it, and always enjoy working with you guys, and appreciate a lot of the cross referrals that we have. Hey, everyone. Thanks for joining us today. So I've been asked to give some points on transitioning a business, first closing a business, and then what goes into and what are some of the legal issues that you face when you try to sell a business. And of course, we're talking in generalities here. I often do a lot of work in the healthcare space. So some of my references may be more specific to, say, a private medical practice or dental practice than, say, a Fortune 500 company. But a lot of the concepts are going to cross industry borders and are consistent regardless of whether the purchase price for a business is, 300,000 or 300 million or 3 billion. The issues, the concepts, the lawyers and the accountants tackle are roughly similar. Of course, when you have a larger transaction, you have larger teams of lawyers and more accountants, and you're able to spend more time and dig into every issue. And when you have a smaller transaction, you have to be much more practical and wiser about how much time and effort and concern you give any particular issue. So let's start with the issue of closing a business, what we would say dissolving a business or corporation. And there we have sort of two main concepts. One's called the voluntary dissolution, and you have an involuntary dissolution. It's very common, actually, that corporations that get established find themselves involuntarily dissolved by, and since we're in Chicago area, we'll talk about the Illinois Secretary of State. You might go and look up the company on the Illinois Secretary of State website, and you'll see that, oh man, I've been involuntarily dissolved. What does that mean? And that kind of goes back to the nature of corporations. And I never know sort of what level to start a discussion at, whether you start from really point A or if you kind of assume some knowledge. But a corporation is a function of state law. It's a creation of the state meaning Illinois or any of the 50 states, that will stamp a document, which are your articles of incorporation, and voila, you have a corporation. And a corporation can do things. It can incur liabilities. It can borrow money. It can take action. It can open up a bank account. It can sell services and goods. It can get into trouble. It can do criminal acts. A corporation, you've often heard, is deemed a person under the law. And all it takes is to file a very simple document with the Secretary of State, and there you have it, a corporation, which is separate from the shareholders. And when a corporation or the owners of a corporation wish to end that corporation, they can simply stop filing their annual reports, and they'll find that after, I forget, 6 months, 9 months, the Secretary of State will consider their corporation to be involuntarily dissolved or administratively dissolved, meaning that the administration dissolved it. But that's not generally a good idea. Generally, when a person wants to dissolve their corporation, they want to do it properly. They want to file what are called articles of dissolution, so that they can sort of wrap things up properly. And by doing that, you're going to avoid certain types of liabilities. You're going to actually maintain your reputation if you're going to venture into a new business after that. And you will undergo the process that's involved in in winding up a corporation. So let's just go through some of the points. When a corporation is ready to dissolve, you need to get proper approval. And again, depends on the type of entity. If you're a single shareholder corporation, you still have a board, directors, and the directors have to approve, and the shareholders have to approve. And so you'll want to document that approval to be formal about how you're going about the dissolution. You file what are called articles of dissolution with the Secretary of State. Then you go about the winding up of the corporation's affairs. And that's think about it as figuring out, okay, what are the assets, what are the liabilities of the corporation, and determining whether you can sell those assets and turn them into cash so as to pay off the liabilities. If you have liabilities that are greater than your assets, then you need to come up with a plan as to how to deal with that. Depending on the nature of those liabilities, even if you do dissolve your corporation, those liabilities may then stick to you individually, and you want to be very careful about that. There's a big process around, not a big process, but there's a process around filing what we call a plan of dissolution. That's oftentimes seen as optional, but you can do it in order to provide some detail around the process, especially if you have a more complicated business with different types of assets and different types of liabilities. What else can we talk about when we talk about dissolution? Let's see here. Well, let me stop there and ask.
Have you run into a situation where you have clients that purposefully dissolve their business because they have lost, there's a group of 2 or 3 people and they've lost the ability to negotiate with one of the people, so they force a dissolution amongst the partners so that they can get the one person that's causing the problem? I ran into a situation where there was a doctor that was something like 85 and refused to participate in any forward-looking things. And they created a forced dissolution to be able to reestablish themselves as something else.
Yep. Yeah. And that's not a voluntary dissolution. That's a judicial dissolution, which is often the sort of ultimate resolution when you have a deadlock in a corporation where, you have major dispute and you're not able to get quorum for a meeting. Directors are not talking to each other. Shareholder partners are not talking to each other. And the corporation's going nowhere. At the same time, you're still incurring liabilities. You're still maybe generating income. Questions are being raised as to who has the authority to do what. And there's a lot of anger and distrust. Sometimes what's called for in that situation is going to court and asking a judge to step in and enforce a resolution, which oftentimes comes down to a forced dissolution of the company and a distribution of the assets and the liabilities among the shareholders, or in accordance to a plan that the judge works with the parties to figure out what's a fair way to deal with that. I personally have not dealt with that, thankfully. Come close, definitely, but have not gone all the way through with that. I'm sure my colleague, Mike Cohen, who I work with very closely, who's a litigator, I'm pretty sure he has. I know that we've threatened it at times in connection with the dispute among partners. In the healthcare space, closing a medical practice raises other types of issues related to your obligations under HIPAA and your obligations to maintain personal health information, private health information, and maintaining your records for a period of time. And so that's something that's more specific to healthcare providers. Does anyone else have any questions around wrapping up a business?
Well, you talked about corporations, Mazen. What you're
Mhm.
talking about applies equally to limited liability companies.
Mhm. Mhm. Yep.
So there's minor differences at the state level, but the thing I really appreciate you said is the corporation or limited liability company, whatever it is, it's formed at the state level. So it's a state legal entity, has nothing
Mhm.
to do with how it's taxed. And that's where there gets to be a lot of confusion. Just because I created an LLC doesn't mean I have a corporation. It means I have an LLC at the state level.
Right.
And I
Right.
appreciate what you said about the involuntary, because um, you really want to watch that. You lose the benefit of a corporation under that involuntary stuff, and it happens frequently, we know.
Mhm. Mhm.
Dot the
Exactly.
I's and cross the T's.
Exactly. And of course, and I would say hugely important is to work with your accountant, your tax accountants, because there are going to be filings that are required when you're closing the business. You want to make sure that you're not continuing to incur penalties. You have to deal with employee issues with termination and obligations to the Illinois Department of Revenue, Illinois Department of Employment and Security, and other agencies. So you want to make sure you're consulting with both an attorney and with your tax accountants.
Absolutely. The key thing is what you said, the plan of dissolution, because what you just said was very critical. There's once you close the corporation, it's not just, oh, I'm going to go close it here. You got to ripple across the board of all those places you got to close it with whomever.
Right. Right.
Yeah.
All right. So shall we move into, let's move and talk a little bit about selling a business.
Woohoo. For
Oh,
lots of money, for lots of money, for lots of money.
well, that's sort of the major issue is how do you know if you're selling your business for the proper value or for a fair and
Mm.
reasonable value? Um, and that can be very difficult, it can be very time consuming. A lot of that depends on the nature of the industry, depends on whether or not a broker is involved, how much you trust that broker, how experienced that broker is. Because if you just happen to find one buyer and you're in a position where you really want to sell, um, you may get taken advantage of on the value. At the same time, I'm assuming that a lot of the listeners are private companies, and private companies don't need to publish their um, sale price for other private companies that have sold. And so it's difficult to do comparison analysis. And that's where sometimes finding a broker specializes, say, for example, in private medical groups, sales can help identify trends and market rates for example, purchase price. There are accounting firms like yours and others that have a lot of experience in healthcare who have seen a lot of deals, and they can help advise a potential owner on the value that uh, that they can demand in the marketplace. So yeah, that's like issue number one is what is the value of your business? Um, and even if it may not be super profitable, sometimes the value in the business is elsewhere, not necessarily just profits. The value of the business is simply in the fact that you have a running business and that you have employees and staff and a system and a certain number, let's say in the healthcare sphere, of patient. You have a patient base. You have a referral network. Maybe in other types of business, you have some type of intellectual property, which maybe hasn't been exploited um, yet sufficiently, but the potential is there. So there are lots of other measures of value, whether tangible or intangible, that are distinct from just profits. And so, one wants to keep that in mind when thinking through what is the value that you're getting for your business. Um, so in terms of engaging with potential buyers, often the first document that you'll see in any transaction is a confidentiality agreement. And the confidentiality agreement goes either one way or mutual in terms of both parties sharing information. And why would the seller want information on the buyer? Well, you want to know who you might be selling to. You're invested in your employees. You're invested in the business that you've done. You want to ensure that the business you're selling to is reputable, is financially viable, hasn't gotten into legal trouble or been party to a lot of litigation. So there is a role for diligence even on the buyer. The term due diligence is kind of a term of art that's used in the mergers and acquisitions world to mean the investigation, the review that parties do with each other, generally the review on the target of the sale or the purchase, which would be your business if you're the seller. And the process of due diligence is really critical. So even before you start engaging in with a potential buyer, once you start thinking that, okay, it's getting time for me to transition my business, you want to start thinking about how do I need to clean up some of the items within my business so that I am looking good. It's almost like staging your house if you're selling your house. You want to make sure that your books and records are up to date. Your accounting, your accounting numbers are reconciled. That your financial statements are clean and recent, and that you've if there are any outstanding tax liabilities or tax issues, that those are addressed and acknowledged and worked through. That your filing system is good, that you've got all the documents you need for your employees, that you have copies of your principal contracts, that you know where they are. Because what happens when you go into a sale process is you create what we call a data room. And this used to be, when I started practicing, believe it or not, over 20 years ago, we actually did these physically, where you would, sometimes they would rent a hotel room and it would just be lines of tables with these accordion files. And each file had subcategory types of documents, whether they're contracts or employee files or vendor agreements or corporate structure or tax filings, et cetera. And so every document and aspect of the business is sort of organized and divided and put in special folders. Now we do that obviously all online and utilizing the cloud to save and organize these materials. But you'll want to start doing that when you are ready to move to a potential sale. What else? When you are engaging with the potential buyer, generally the next document you would have is a term sheet. And the term sheet would set out the principal terms of the transaction, purchase price, what the role of the seller will be moving forward. Will the seller continue to be an employee? Will the seller be getting equity as part of the consideration for his business in the buyer? What will the seller's responsibilities be, including most likely a non-compete that the seller would agree to as part of the transaction? And quick point on non-competes here is that as you may have heard in the news, non-competes are being scrutinized more and more. And it's law now that if you make less than $75,000 a year, an employee that makes less than $75,000 a year can't be even subject to a non-compete. And in Illinois, there's a unique rule where non-compete has to have distinct and separate consideration for it to be enforceable for the first 2 years of its existence. So if an employee was to walk away or be terminated within the first 2 years, you didn't give that employee something specific, consideration that's specific to the non-compete, whether it's $100 or $500, it's very possible that the court would find the non-compete to be unenforceable. So in a sale of a business context, whereas with employees, generally a 2-year term would be deemed like on the longer side of a non-compete. When you're selling your business, the standard is 5 years, and that would be enforceable in a court. So it's a very different, stronger non-compete than just a standard senior employee. When you're thinking through the different elements of your business, you want to look at the different types of assets you have, the different type of liabilities that you have, what sorts of intellectual property that you have, and whether the assets or the different equipment or aspects of your business, whether you actually own them or you finance them, because that matters. When you're selling the business, you need to be able to take your business and all of its components and give it to the seller. And whether it's you have to figure out whether those assets are transferable. Deals are structured, more often than not, they're structured as asset deals, which means that contracts in particular need to be assigned over to the buyer. And whether a contract is assignable is a investigation, is a process that we go through, or the seller goes through, to make sure that they are. Many contracts will say not assignable unless there's consent. For example, one of the most important documents or contracts for example, in a physician group sale is simply your clinic's lease. And the landlord, most likely than not, will have a consent right on the potential assignment to a buyer. And want to make sure we have the landlord on board, because the landlord could get greedy or could muck up the deal by asking for changes in the lease or some sort of fee or just delay, not be available. And a buyer is not going to want to take a business where they're not sure that they have the right contracts assigned over. So that's always an important aspect of a business. Similarly, governmental permits and licenses need to make sure that those are or are not transferable. Many times they're not. And so a buyer will need to be sure that they're able to conduct the business as they anticipate. They will make sure that they've got those permits and licenses perhaps effective in advance or at least concurrent with the closing. Any legal claims that may be outstanding with the business need to be assessed. If there's litigation, where that is, how that's going to get resolved, whose responsibility it will be. Of course, any debt on the books, whether it's common sort of trade payables or if it's long-term debt, shareholder loans, intercompany type arrangements, and shareholder loans, whether to or from shareholders, and making sure that that's properly on the books and that there's a plan for how that's going to be addressed in the purchase agreement. Depending on the type of business, environmental issues, and then also insurance coverage. What sort of insurance does a business have that you own, and that the buyer is going to want to be looking at what type of insurance you have on place and types of insurance they may need to adjust that or increase that when they're looking at taking over the business. As far as the types of buyers, there's the main distinction that's made in the marketplace is strategic versus financial. Strategic buyers are buyers that are already in that industry that are operating entities. Maybe they're a bigger health group, maybe they're a hospital system, maybe they're a multi-specialty practice. They are an operating entity. A financial buyer is a private equity firm or a venture capital firm or a group of people who are coming together to make a financial investment. They're not really operators. They're looking to make an investment and then reap the returns of that investment with another sale of your business down the road. And so there are often separate issues associated with the transaction and the process of the transaction, depending on whether you're dealing with a strategic buyer or with a financial buyer. Often the sensitivity of the information in terms of your trade secrets, your intellectual property, your vendor contracts are heightened when you have a strategic buyer. Also, um, the level of confidence and discreteness that you need in terms of how many employees will know about this potential transaction internally is very important in both, but in particularly in the case of a strategic buyer. You know, you may have employees who don't want anything to do with that strategic buyer, or who want to move to that strategic buyer, and so they start behaving in ways that are not consistent with what you want as an owner in terms of how you position the company to maximize value on the sale. I've been talking for way too much. I will pause here and see if anyone's got questions.
I have a question. I have
Sure.
a client that we've been assisting who sold his company, and the company closed, and then he decided, because the person that bought the company advised him such, that he shouldn't tell the employees for 60 days, so that the
Yeah.
other after the sale, because he's staying on as a consultant. They were concerned that people would leave, but the advice that he was given was, don't tell your people for 60 days, because then you'll tell them this happened and you'll see nothing impacted the way we run the business.
Mhm.
So I don't know if you've ever seen this. It's just my inclination is that's really a bad idea, because if anybody did that to me, I would immediately decide that whoever this was sold to was not going to be transparent. But I just don't know if you've seen that, or whether there's any legal, I don't know. Do you have to tell the employees who owns the company they work for?
That's a great question. I don't know that you do. That employees have a right under the law, for example, to know who exactly the owners are of the company. But when you're dealing more with smaller, mid-sized businesses, especially with your more senior employees, who they work for makes a huge difference. And um, at the end of the day, often things are really based on relationships and trust. And like you're saying, not telling your senior employees that you've sold the business and them continuing to think they work for you when they're working for somebody else who they don't know, is just a recipe for um, disaster. So I would
Especially when the
definitely.
company was purchased. This was not a purchase of assets. This was a company purchase. And I guess the thing that I was thinking about is, I'm not an attorney, but I thought you kind of have to operate in good faith. And so if they have an employee that wasn't going anywhere, that's okay. But if they had an employee that was given a job offer for more money and turned that job offer down, I would think, if nothing else, even if they don't win the lawsuit, there's a possibility that they would get sued because the owner was not interacting with the employees in good faith.
Um, I'm not sure. So the lawsuit would be on the basis that they just didn't know?
On the basis that they made a decision to turn down a job based on a representation that this person still owned the company.
I mean, if they had that representation somewhere and their boss lied to them, sure. But anytime you think about lawsuits, you have to ask, well, what is the damage? You know, and here maybe the damages are the opportunity cost that they would have made if they would have had a higher salary at the other employer, perhaps. But that would be I get the sense that that would be a tough case.
Well, and in this case, they paid the employees a significant bonus, or they're going to be paying the employees a significant bonus for the holidays. And so that might be just one of those things to sweeten the deal so that people don't do that. But um, when, I mean, when do you tell employees that you're selling the company, especially if you're a closely held business where the person that owns the business is the heart of the business.
Yeah, I think that's a very difficult conversation that has to happen upfront. It should also happen with the potential buyer. I've seen cases where the buyer gets ahead of the seller and the buyer starts talking to the seller's employees before the seller owner ever got a chance to tell them. I mean, just a complete disaster when that's happened. But deciding how and when to tell your employees about a potential sale or about the sale is a tricky matter that requires some thought, and it requires looking at those employees' contracts, if they have employment agreements or if they just have like offer letter agreements, or what sort of um, arrangements are in place and obligations are in place with the company as it is now. And then shoring up the plan for those employees with the new employer. We need to know whether those employees are subject to non-competes and whether those non-competes are transferable. Because if they're not, that could really, really affect the transaction and the value of the company, especially a service providing company where your key employees are the revenue engines of the business.
Well, then
Like
I
the
could
health.
also see that the company that's selling, the person that's selling, if I'm buying, I would want the person who's selling to sign a whatever the word is, you can't steal my employees. Because I might go into different industry, but I would want those, like our administrator, Janine, is so wonderful that if I ever left the company and went to a different business, I wouldn't steal her to be an accountant, but I'd steal her to be my administrator.
Over my dead body.
Right. Yeah. And that's called a non-solicitation. And the non-solicitation is almost always incorporated into the section on restrictive covenants, what we call restrictive covenants, which includes the non-compete, confidentiality, non-solicitation, and often also includes non-disparagement. And the non-solicitation is not just employees. It can also extend out to vendors, suppliers, service providers, even customers in certain cases, employees, independent contractors. So you want to have a broad, the buyer would want to have a broad non-solicitation. There's a variation on the non-solicitation or an addition, which is we call the non-hire. So if you look at a non-solicitation provision, the heading might be called non-solicitation, but the actual language says you shall not hire or attempt to hire or solicit. So it's actually, you can't hire them, whether you solicited them or not. So you could have like a very dedicated medical assistant or office manager or physician assistant who wants to follow you to your new employer. And you may not even have solicited them. They just are, connected to you, and that's what they want to do. If you sign a non-hire and your non-solicitation includes the words "you shall not hire," then you'll be in breach of that, and the buyer could take action to prevent that, or to rescind it, or to avoid it, and so forth. So, I would never allow a seller to sign an agreement that has a non-hire, but it's in there sometimes.
What about buy sell? And we just came into a situation right now where a client of ours is looking to buy a restaurant.
Mm-hmm.
And when they went in for the second visit to do a walkthrough, the owner wanted to know if they had brought the money, i.e. the cash. Would you tell a client to run the other way if that shows up?
Probably. Did the seller think that the buyer was coming with the cash on the second visit?
Yeah, the seller thought the buyer was coming with a bag of cash. This is an all cash business.
Yeah. No, look, as lawyers, we have to be practical. We have to understand that there are different cultural and industry norms on various businesses, and we have to be practical, but at the same time, it's our job as the attorney to protect our client. And that's why we always want stuff on paper. It's got to be documented. And we have to think through, and we're conditioned as corporate lawyers to think through, okay, what's the worst case scenario here? And how do we address it in the contract? Very important. And this isn't particularly important, especially on the formation of a business where you have other shareholders or investors, or you have partners that you are bringing on to do things for the company going forward. And so they are promised or they are given a share of the ownership of the company over a promise that they are going to lead marketing, or they'll take care of the website and the back office matters. And lo and behold, the company gets started. They put in a month or two worth of work and then they disappear. What happens to their equity? If you didn't organize it right, if you get an attorney involved in the beginning, you might find yourself stuck with somebody who owns 25% of the business but has walked away and is no longer doing anything. So that's not the type of structure you want to have. You need to set things up properly so that you account for worst case scenario, including, I always use the term, what happens if they get hit by a bus? Because we live in Chicago and we're walking across streets, you can always get hit by a bus. It's actually a possibility. And so you got to ask, okay, well, I'm teaming up with these people and this is going to be my partner. We're going to go into this business together. We're going to start a medical practice. We're going to, start a restaurant business. We're going to invest in this project. What happens if they get hit by a bus? Would their spouse then come into their position in the company and have a vote and be able to co-manage the business, even if their spouse has nothing, no background, no interest, no idea what's going on? Or is there a procedure in the contract for how that person's equity is treated and whether or not there's the ability to purchase it back, or whether there's insurance some company will purchase in order to cover what the loss of what we call a key man or key person insurance. So these are a myriad of issues that are important more on the setup, and that could be for a separate presentation sometime
So
in the future.
I know we're coming up on 45 minutes, so I just want to ask one real salient question.
Sure.
If you think about you want to buy a business, you kind of have an idea, you look around, you find something. When in that process do you bring in an attorney? When is the most crucial time to bring in an attorney if you're buying or selling a business?
Before you sign anything, I would say number one. So even a non-disclosure agreement, I would bring in an attorney, and for sure before you ever sign a term sheet, because there's often things that are put in there that it looks like boilerplate, and it reads like boilerplate, but it's not really boilerplate. And so I would say before you sign anything.
And so I will ask you to respond to one last question. I had a client who was selling something and he said, I don't need an attorney because the buyer has an attorney, so I'm sure this is going to be legal.
Yeah, and it's not so much about the legality of the transaction, it's about the terms on which you're transacting, and ensuring that you are protected and that you are getting the deal that you think you're getting. Because a person can promise you the moon, but sell you a fish, because the document says you're buying a fish, even though they told you you're buying the moon. And then the document will also say that This agreement is the entire understanding of the parties, notwithstanding anything verbal that may have been mentioned or said or exchanged between the parties. So,
Oh, wow.
yeah, so that's, that provision, which we call the entire agreement provision, is standard. And that's why you need to put things in a document and understand what you're selling and what you're buying. Absolutely critical.
Okay, well, thank you for your presentation, and full disclosure to anybody seeing this video, Bill and Lorna and I, who are on this call, bought our company with the representation of Mazen, and he actually helped us negotiate and get to a very fair deal, because neither of us are overly happy. We got to
There
the
you go.
point we were both a little grumpy, which meant that it was the right deal. And you covered you took care of us very well. So thank you for that.
I appreciate that. Well, you guys are very sophisticated, obviously, so it was very easy. But I appreciate those comments. Thank you so much.
Well, you kept
Well,
bringing up things that we never thought about, which was why what you needed to do.
yeah, and I would just add that the earlier you bring somebody like Mazen in, the better, because I got a headache listening to you, Mazen. It's like, I got to think of this, think of this, think of this. It's like due diligence just kept coming up over and over and over and over. So I think like making sure you're doing something other than buying the pie in the sky would always be a good idea, because I mean, I can even see now there's issues. It's like, do I buy the stock? Do I buy the assets? What am I going to buy? You said more often an asset person. It's like, I'm sure there's all sorts of legal ramifications to whichever way you go that we didn't even touch on.
We didn't
And we
go.
don't have time to, so, but it's something that don't get caught. Make sure you get advice up front.
Yep. Yep. And also remember that lawyers, like physicians, like other professionals, have specializations. So you don't go and use a lawyer who specializes in family law to handle the sale of your business. You don't use a criminal lawyer to handle your tax dispute with the IRS, unless, of course, criminal matter. That's a different thing. But there are specializations in the law, and you should really take a close look at an attorney's background and where they've trained, how long they've been in practice, and check also with other clients maybe that they've worked with in the past.
Awesome.
Okay.
All right.
Well, thank you again.